Forget everything you think you know about mortgage underwriting timelines. In 2025, a 45-day underwriting delay isn't a worst-case scenario anymore. It's the baseline. And if you're buying a home or refinancing right now, this timeline squeeze is silently killing deals. I'm pulling real industry data today to show you exactly what's happening, why it matters to your wallet, and the specific moves you need to make before you sign a purchase agreement. Let's start with the numbers, because this is where most people get blindsided. According to Q1 2025 Fannie Mae and Freddie Mac servicer reports, the median underwriting timeline has stretched to 8 to 12 business days for initial approval. That sounds fine, right? Until you add in the 70% of files that now go to suspended status, meaning additional documentation requests, property reviews, or employment verification. Once you hit suspended, you're looking at another 15-25 days minimum. That's not 8 days. That's 23 to 37 days before clear to close. But here's what actually matters. 34% of delayed underwriting cases now miss their original closing dates, not by a day or two, by an average of 8 to 12 days. So why is this happening? 3 reasons, and none of them are what you probably think. First, lenders overstaffed during 2023's rate surge and now they're understaffed. Underwriters retired, took jobs with smaller firms, or left the industry entirely. Less staff plus more volume equals longer queues. Second, and this is critical, regulatory tightening on loan quality. The CFPB increased audits on mortgage lenders in late 2024. Underwriters are now double-checking income documentation, running deeper background checks, and escalating marginal files to senior reviewers. That's not a bug, that's a feature. But it costs you time. Third, technology actually made it worse, not better. Most lenders are running manual systems alongside automated systems, creating redundant verification steps. They have to approve digitally and manually sign off. It's like asking someone to lock a door twice. Let's talk money impact, because delays aren't just frustrating, they're expensive. Your rate lock period is typically 30 to 45 days. If underwriting takes 35 days and you haven't closed, you're extending your rate lock. Most lenders charge 0.25 per 0.5% per extension. On a $400,000 mortgage, that's $1,000 to $2,000. But there's a worse scenario. Your rate lock expires during underwriting. Then you're refinancing your interest rate upward, potentially losing $150 per month in payment savings. Over 30 years, that's $54,000 in lost equity. And I haven't even mentioned this. Delayed closings mean your home insurance doesn't activate on time, your property taxes shift, and you might owe daily interest on your construction loan. On a $500,000 loan, that's $68 per day in additional cost. Now let's talk about the deal-killing scenario that nobody sees coming. Seller gets nervous. You're 50 days into underwriting. The seller has another offer ready to go. They walk, you lose the house, your earnest money deposit, usually protected, but you just spent 2 months in escrow with zero fallback. This is happening right now in competitive markets. 23% of transactions that exceed 45-day underwriting timelines result in contract cancellation, either by seller frustration or by buyer walkaway due to rate lock expiration. The red flags. Okay, so how do you protect yourself? First, know the red flags that trigger extended underwriting. Flag number 1, self-employment income. If you own a business, underwriters are requesting 2 years of business tax returns, profit and loss statements, and a CPA letter. This alone adds 8 to 14 days. Flag number 2, recent job change. Changed employers in the last 2 years? Underwriting now requires a written job offer letter and 30 days of pay stubs from the new employer. If you haven't hit 30 days yet, suspension. Flag number 3, gift funds. Using parental money for down payment? Underwriters now require a gift letter, bank statements from the giver, and statements proving the funds seasoned for 60 days. Any inconsistency? Suspension. Flag number 4, low credit score. Below 640? Underwriters do manual review. 620 to 680? You're in the danger zone for 15 to 20 day delays. Flag number 5, Debt-to-income ratio above 43%. Underwriters will request additional documentation, dispute old debts, or require you to pay down accounts. If you're 44 to 50% DTI, you're getting suspended. Here's what most first-time buyers don't know. You have power in the underwriting process. Most people think underwriting is passive. You sign documents and wait. Wrong. You can actively speed this up. Instead of waiting for underwriter requests, proactively send documentation on day one of underwriting. I mean all of it. 2 years of tax returns, 60 days of pay stubs, bank statements, documentation of gift funds, letters from creditors explaining any late payments, proof of employment. Yes, it's a document dump, but lenders processing files with complete documentation move 40% faster than files with missing pieces. Second move, request daily status updates. Not weekly, daily. Ask your loan officer to check underwriting status every single day. This does two things. It keeps your file prioritized, and it surfaces problems before they become bottlenecks. Third, use your inspection period strategically. Don't schedule inspections until you have conditional approval. Otherwise, you're racing underwriting while contractors are in the house. Now, what if you're already in a delayed underwriting situation? First conversation with your seller. If underwriting is already delayed, request a closing date extension in writing. Don't wait for underwriting to catastrophically fail. Proactively extend. Most sellers will accept a 5 to 7 day extension if you ask now versus springing it on them later. Second conversation with your lender. Ask for rate lock extension. Yes, it costs money, but how much? Get the exact number. Then calculate, is the rate extension cost worth it versus refinancing the rate upward? On a $400,000 loan with a 0.375% increase, you're paying $1,500 to extend versus $150 per month forever. The extension is cheaper. Third move, escalate in underwriting. Ask to speak with the senior underwriter directly. Explain your situation. Most underwriters will prioritize your file if they hear directly from the borrower. Pattern number 5. Let me give you one more stat that should terrify you if you're currently under contract. Refined Institute data shows that 62% of mortgage delays in 2025 occur between underwriting and appraisal. Why? Because appraisers are now also backed up. Lenders order appraisals late. Appraisers take 10 to 14 days to complete, and then you send results back to underwriting for final review. That's a 2-week delay right there. In your original 45-day underwriting timeline, appraisal becomes the actual bottleneck, not underwriting. The fix: order your appraisal on day 1, even before conditional approval. Ask your lender if you can pay for the appraisal up front to jump the queue. Most appraisers work on a first-come, first-served basis. You pay first, you get scheduled first. Action plan. Okay, concrete action plan for you. If you're shopping right now, ask lenders about their current underwriting timeline. Don't ask hypothetically. Ask for